I think of my investing in terms of the underlying virtues or characteristics or attributes which are fundamental to create value. Which are basically what I mentioned earlier, the large size of opportunity coupled with a great management. The two together will cause a growth. Apart from that meaningful growth, it has to be sustainable, long-term, predictable one. The quality of the growth has to be right in terms of the capital efficiency so that the growth converts into economic value. It is our job as investors to judge the value rather than chase the prices. Having determined the real value, we must have discipline to buy them at margin of safety. And having done all of that, don't flirt with the positions unless the real fundamental value of the business has changed. And market fashion and fad or opinions may change, but the real value, unless there are material causal fundamental factors, remain intact. And to that extent, our focus has to be on the value. And so long as that remains intact, we ignore the short-term noise. This is what investing is about, and we find these attributes or the virtues in large caps, mid caps, small caps. Bajaj Finance, we've been invested for almost 9 to 10 years. Bajaj Finance 10 or 11 years back was worth only about 2,500 crores. The value of the firm today is about 235,000 crores. We continue to see the value. A company like PI Industries, we have been invested for more than 10 years. 10 years back, probably the market value of the firm was not even in the 4-digit number. And today the market value of the firm is good, almost about 18,000 crores. So many of the businesses will cross the hump if they grow, if the quality is right, and they will become bigger. But equally, large ones can become smaller if the quality is not right. So virtue is not about mid cap or small cap or large cap. Virtue is about whether the businesses possess what it takes to create value.
Yeah, also
that could happen with small ones, mid ones, large ones.
Right, right. So also, does it present a tactical opportunity to, to play by valuation mismatches? Obviously, these names that you just mentioned, while in today's day and age are, slightly heavier on the valuations, the last 10 years, in the last 10 years, obviously, they've also grown in size. So when you identified them as opportunities, they were probably smaller in size. So I'm talking about such opportunities which can present themselves now in the form of being a company in a smaller space, but the potential to become the next Bajaj Finance, the potential to become the next PI industry in the next 10 years to come.
Well, but that's exactly what I've been saying. I mean, so a portfolio will obviously consist of all the opportunities, the ones where there is a degree of size today, but there is a potential for it to become bigger. Equally, there may be relatively smaller businesses today, but if they have what it takes to become bigger and the right character, then obviously those are worthy too. And we have to have ability to find such opportunities across the spectrum. So there is nothing special about choosing from mid-cap or large-cap is a fundamental necessity. We have to look for the qualitative virtues that may reside in some of the small ones, some of the mid-sized ones and large ones. As they are today, across the spectrum opportunities are available. But we tend to give the appellation and titles and give them labels as to mid or large or this or that, and that is where I think we get carried away and make mistakes. So issue is not about mid or large or this or that. Issue is about whether businesses have got what it takes to create value. Secondly, often the way of judging value is by what I would regard as not very adequate, rather superficial measurement of a price earning multiple. Price earning multiple is not a very efficient way to measure a value. At every point of time, even in the most bullish markets, by and large, a preponderant number of businesses will be at conventionally price earning multiple basis at a cheap number. Because large number of businesses are mediocre and they deserve to be assigned a valuation which unfortunately people seek to infer valuation conclusions by looking at the price earning multiple. Real value of the business is inference about their cash flows, the incremental cash flow over the life of the business, the capital efficiency, finding a suitable discount rate, it to discount those future cash flows, judge the character of business so that all of these are possible to infer. All that is both science and art, and that more difficult exercise really is a more satisfactory way to judge a value. Price today and earnings tomorrow or day after, which is what price earning multiple is a very poor and inefficient way to judge that value. But unfortunately, because it is simple, people tend to make wrong conclusions by looking at that number. PE is actually a derivative of a cash flow based valuation and not the other way around. Therefore, how can what is derived from value of the business can itself be a determinant of value? That is the fundamental contradiction there. And therefore, many of these macro or loose conclusions often markets seem to make about this being cheap and that being cheap actually is very superficial, and it needs to be dug deeper.